Welcome to the Ultimate Gold panel. First and foremost, thank you to Jay for having me back. I absolutely love moderating this panel, and this is one of my favorite conferences, and what a fantastic crew we have lined up here. So lots of questions for you today. So let's just dive right into it. As we all know, 2019 was a fantastic year for gold and the miners. 2020 has started off with a bang. How many of you feel confident that this rally can continue throughout the year?
Well, short term, with the Chinese New Year, you usually get this sort of seasonal correction, but the DNA of volatility for gold for the past 20 years is plus or minus 20%. Is this an easy move? So we could see gold tack on $300. That's very simple to do that. Especially in the economic scenario in the 2020 election year.
Well, Bridgewater coming out also saying, $2,000 gold this year could really happen. Does that feel like a far-fetched number to anyone, Rick?
One of the things I've learned watching the gold market over, 9 rebounds in the course of my career is that it surprises you to the upside. And it surprises you to the downside. Everybody wants forecasts, and I studiously avoid them now. But there's no particular number that scares me. What attracts me is, of course, that just the narrative is, it's wind and gold sales. 2,000, sure. 3,000, maybe, I don't know. If you think about gold trading inversely to confidence in, as an example, US 10-year treasuries, I think we're doing everything we possibly can do to reduce confidence in the US 10-year treasury. So I think gold does fairly well. As to a number, I'm too old for that.
Grant, do you want to make the case of why we couldn't see gold possibly fall back down to 1,300?
Look, yes, of course you can see that. You can always see that with gold. It's inherently volatile, and that's never going to change. I think if you look back over the last, I guess almost 20 years now, you've seen, certainly between 2000 and 2011, we had 7 big bull runs, and each one of them had a major consolidation correction, and those often would last a year or more. And so, buying and holding gold has definitely been the right strategy, unless you're a very good trader. And unfortunately, I think a lot of people that get sucked into the gold and silver mining space are not very good traders because they trade with this and not this. It's a very difficult thing to do because gold's an emotional asset. But for me, I think the big change we're seeing is that the precious metals mining stocks have really been the purview of traders for the last several years. There weren't really any investors in the space. And that, I think, is starting to change. And when you see people like, as I put in my presentation yesterday, people like Paul Tudor-Jones, Stan Druckenmiller, Ray Dalio, investors coming out and saying, this is our best trade for the next 12 to 24 months, or this is my biggest currency allocation, I think that's a sea change. And if you get investors moving into the gold space, I think that's going to make a huge difference.
What will it take for that to happen? Is it, do you just need rallies?
I think it's absolutely happening. I think we've started to see the beginning of that. I think this last leg up in the mining shares has not been driven wholly by speculation. I think you'll find when the kind of water subsides a little bit, the tide's not going to go all the way out like it has done many times over this sort of last 8-year period since the 2011 top. So I think that's the big change, and I think it's a really important one for people to understand.
Peter? Thoughts on, well, I know how bullish you are.
Of course, every year I'm overconfident on what happens to the price. Although last year, I was at this conference, I was on a gold panel. I don't think the panelists were the same. They were different people. But I was the only one that even thought the price of gold was going to go up last year. In fact, everybody was saying it would go back down to 1,000, and I thought that was very improbable. And now you're throwing around, could it go back down to 1,300? Look, it's possible, but I think it's highly improbable that that's going to happen. Gold has broken out. 1350 was a 6-year high that capped every rally. I think we took it out. We've never looked back ever since. We now seem to be building support around 1550 or just under 1550, which was the high before we had a pullback to around 1450. So the market looks very strong to me. So while it's possible that we could get that large decline, I wouldn't want to hope for it or bet on it. I think that there's a lot more upside potential, and I think the numbers that Dalio is talking about, 2,000, not only is that very probable, but depending on the outcome of this election, we could go much higher. I mean, if Bernie Sanders were to be elected president, just imagine what would happen to the price of gold the very night the results came in.
And I want to talk about the election in a bit, but first, how much of gold holding above 1550, Peter, do you feel has to do with, the underreported repo crisis here and the liquidity that the Fed is injecting? Is that
It's all a function
holding it
of the Fed, and in fact, I think what people should take away from this recent geopolitical tension in Iran, what rallied, because the dollar didn't, U.S. Treasuries really didn't. I mean, you had a little bit of rally in the yen and the Swiss franc, but the main rally was in gold. And that shows you that the world prefers gold to dollars. I mean, the dollar and gold are competitors as reserve assets. And the fact that people are more and more skeptical of holding dollars and want to hold gold tells you what's changing.
What is rallying and seems to not be stopping is the U.S. stock market, though. So despite missile strikes, oil market turmoil, impeachment proceedings, how long can the U.S. stock market keep rolling here, Frank?
Well, what's interesting is Switzerland is floating these negative yields, and they're not buying gold, they're buying stocks. And they show up in the top 10 as largest shareholder of Apple. They are biggest shareholders of their own stock market. The same thing is happening in Japan, that they're buying their ETF of the index. So you're seeing them float this paper money and then reposition in real assets. And they believe the real assets are public companies. So that's levitating this sort of overall, these other equity markets. And we are seeing here is there's less IPOs. When you take a look at the scheme going back the past 20 years, you're seeing just the less number of public companies, but the same amount of money is going back in and buying less names, and you have buybacks, still the third year of mega buybacks. So that's shrinking the number of shares outstanding, and that's helping propel this market.
Rick, do you see any signs of the U.S. stock market slowing down?
With the caveat that isn't really what I do. I'm more sort of a bottoms up or fundamental investor than a top down investor. There's a lot of liquidity in the market. There's a lot of confidence in the market. As Frank says, corporate America's cost of capital, especially debt capital, is at an all-time low. So you're seeing companies substitute what they see as cheap debt for expensive equity and buy back shares. So I suspect until we have some form of liquidity problem, if we do, or some crisis in confidence, that equities could continue to do well. We're in a circumstance that I've never seen before. People buying negative yield bonds because they think the interest rate will go lower. So they're buying bonds for capital gains, which doesn't make any sense to me, but it's worked. And they're buying stocks for income, which normally doesn't make any sense to me, but it works. So I guess if you look at a whole bunch of circumstances that you don't understand and people ask you if it could continue, you have to say yes.
Just to give you an idea, that we had Chrysler Pension took $300 million of money we managed in the small cap space to buy 30-year zeros. I mean, just think of that thought process, because that CFA, that money manager, thinks it's more important to be buying 30-year zeros.
Grant or Peter?
Yeah, well, as Rick said, I mean, it's irrational, so it can continue until it can't. And
Peter, I didn't say it was irrational. I said I didn't understand.
Well, that's because if it was rational, then you can understand it. But all bubbles pop. Just a question of when. It's not like this bubble is any different. It's going to pop. And the thing is, when it does, very few people who are in it are going to realize it, right? Because when you don't know it's a bubble, you don't see the pin. And every time there's a decline, the attitude is just, well, buy the dip. This is just another dip. And you don't know when the dip is the bear market. You just don't know when it's going to fall and keep on falling. So I still think the only rational thing to do is not participate and to, position yourself for when the music stops.
So you're not participating?
Well, I'm not in the U.S. stock market, but I'm in gold stocks. Gold stocks beat the U.S. stock market last year. They beat it the year before. So I'm still participating, just I'm in a different party. I'm at one that's just getting started, not one that's going to get raided by the police.
Grant?
Yeah, I think what's you mentioned the repo thing there and the liquidity that the Fed have injected. And I think that's the one thing you can put against the stock market, you can see this rally began when they started this thing which they've called not QE4. And what I think people really need to pay attention to is the narrative around what the Fed are doing, because they've had this amazing tailwind behind them where they could stand behind their podiums, tell people what they're doing, tell people why it's good for them, and everybody just fell in line, believed it, and carried on. And what you've seen with this repo situation, the Fed has been out desperately trying to convince people that it's not QE4, and they had a very short window where that kind of was left and people didn't challenge it. But if you look now and you start reading a lot of the op-ed articles, particularly Bloomberg's done a great job of this, you'll start to see a lot more articles challenging that assertion by the Fed. There was one that said, I think the argument about QE4 is over and the Fed lost. You didn't see any headlines like that at any point during QEs 1, 2, and 3 or Operation Twist. And more, the kind of scales are falling from people's eyes. And I think as this narrative shift takes hold, it's going to get harder and harder for the Fed to just jawbone the markets where they want it to go. So people need to really pay attention to the attitude that the financial press are taking to what the Fed are saying, because this is exactly what we saw with WeWork, for example. And I've talked about this a lot. WeWork was 3 weeks away from being potentially a $90 billion IPO, and 3 weeks later it was bankrupt and being bailed out by SoftBank for no other reason than the press and the narrative turned on the company. All the nonsense they put in their S1 filing for their IPO was out there. People have been writing about it and talking about it and laughing about it for years. But the narrative was that Masayoshi Son was a genius, SoftBank was a visionary company, Adam Newman was this wacky guy who was going to reinvent all these kinds of things, and that space as a service was actually a thing. It was never a thing. But one morning, when they filed the S1, the narrative changed, the press jumped on them, and $90 billion evaporated like that. That's what happens when narrative change.
And I think, too, an important similarity, we haven't seen a market this overvalued since 1999, 2000, the dot-com bubble. But the privately traded companies like the WeWorks, these unicorns with billion-dollar valuations, they are really this bubble's dot-coms. And if you remember, before the entire NASDAQ collapsed, the dot-coms collapsed first. They started to go down in 99, early 2000, and the NASDAQ itself peaked later and then ultimately imploded. And so people are missing the fact that private equity bubble has already popped. And for now, just like it was in 2000, so money is moving into some of the publicly traded stocks instead. But that is a harbinger of a diminution of risk and risk appetite and the willingness to embrace this kind of nonsense. Just buy anything because it's going to go up. So that is coming out of the market. And so that's just another warning sign that we could be nearing the top. We're maybe not at the top, but there may not be much left in this bubble.
There's also a school of thought that should the Democrats win the election, that could trigger a market sell-off. Does anyone feel strongly or feel that could be?
It definitely will. And when Trump was campaigning and the conventional wisdom was, Trump is going to be terrible for the stock market, I always said that's nonsense. I mean, why would people think Trump is going to be bad for stocks? He's promising to cut taxes. He's promising to get rid of regulations. What about that is bad for stocks? But in the case of a Bernie Sanders or Elizabeth Warren, they're promising massive tax increases. They want to take control of corporate boards. They want to turn the means of production over to the workers. And they want to raise taxes significantly. They want to impose new wealth taxes. I mean, I can't think of anything worse for the stock market than that. Yet no one's even worried about the possibility that this might happen.
Well,
and the media love Bernie Sanders and Elizabeth Warren. They get all the coverage. But I think it's important is that Donald Trump is the only president, so many people have said, that looks in the mirror every morning, checks his hair, and then what does the stock market do? I mean, he just knows the stock market's a precursor of economic prosperity. It's always 6 months out, and he's very focused on that growth of the stock market. But I think that if Bloomberg wins, if I think that there's a huge swing vote that happens with what they call conservative Democrats and liberal Republicans, and they swing back and forth on who they vote for. So I think if there was a real race, that it could be, if Bloomberg's there as a Democrat and he wins, I think that'd probably be.
But what is the likelihood of that, Frank?
That swing vote's so important.
I had one reader write in saying the Fed policies have generally benefited the rich and led to massive U.S. wealth inequality. Would this not benefit candidates like Bernie Sanders?
Would that narrative not benefit them? Yeah,
Yes.
absolutely. But look, it's real, and it's not just a US problem. That's the thing here. And I think if you pay attention around the world, you'll see that this tearing of the societal fabric is happening everywhere. I mean, in the last year, we had unrest and street protests everywhere, from Colombia to Bolivia to somewhere like Chile, which has historically been an incredibly stable society. They had the worst riots they've seen in 30 years because they raised rush hour subway fares by 4 cents. We saw it. We saw hundreds of people, excuse me, die in Iran and Iraq in protests. We saw it in Hong Kong. We saw it all across the world. And what generally has triggered most of these things has been inflationary. It has been either an increase in prices, or it's been the end of subsidies, or an increase in taxes on fuel. We saw that in France. This Gilets jaunes protest has been going on for over a year now, even though it's not on the front pages anymore. So everything's very precarious, everything's very fragile here. But that wealth divide is one of the big driving forces, and you can trace it directly back to central banks in 2 steps. It's not a complicated set of dots to join.
Yeah. And I think too, based on how unpopular capitalism has become, thanks to the Fed and the government, I think that Bernie Sanders can ride that same type of wave of voter discontent, because they're being told constantly how great everything is, just like they were being told that while Obama was president. And that wasn't true. And Trump tapped into that vein with, make America great again, and I'm going to drain the swamp. And he didn't do either. And so I think that Bernie Sanders can get a lot of mileage with, let's make America socialist. Because if capitalism didn't work, and that's what most people think, well, then let's try this. I mean, forget about the fact that socialism has never worked. That's not going to stop us from trying it again.
I want to bring it just back to gold here, because it's been having, as I said, an incredible run and whatnot. Perth Mint gold sales have surged in 2019, but the U.S. Mint has seen its worst year on record. So what is the North American audience not getting here?
Well, it's a good question, because a lot of this run has been in the futures market, and you're seeing that also in gold stocks. If you look at the GDX and GDXJ, a third of their assets are investments from the triple bull and triple bear, and 50% of their volume happens to be because of the triple bull and triple bear. And that regulatory world, I know from my age, it says basically it's too speculative for me to buy a junior mining stock, but it's okay for me to buy a triple bear or triple bull. So you're seeing more money going into leveraged futures, or you're seeing going into leveraged ETFs on the index, and you are seeing real money being allocated. And so that just creates a sort of different volatility in that space.
Yeah, well, the answer to that is kind of simple. I mean, and I'm in the gold business. Shift gold, we sell gold, and
right.
I can see what's happened to our domestic sales, which is most of our business. But you have 2 factors that are very important here. One is that the price of gold has made a new high in pretty much every currency but the dollar, so the bull market is far more apparent to people in other countries. The biggest gold buyers in the U.S. are Republicans. They were very worried when Obama was president, and so they bought gold as a safe haven. They're not worried. They're optimistic now that Trump is president, so they're buying the stock market instead of gold. And if you look at the relative performance of gold versus the stock market, let's say over the last 4 years, gold's up 50%, U.S. stock market's up about 70%, so U.S. stocks are beating gold. That's not the case in foreign markets. Gold is beating foreign stock markets. So people around the world are seeing the performance not only in terms of their currency, but it's beating their equity markets. Yet Americans don't see the bull market, and they're wildly optimistic when they should be extremely cautious. Americans should be selling U.S. stocks and buying gold. And it's interesting that gold has already done better during the 3 years that Trump's been president than it did during the 8 years Obama was president.
Rick or Granite, any insights as to why you think Americans and Canadians are not buying gold here?
Well, I disagree with the thesis.
What are you seeing? You have different...
We are seeing inflows at Sprott into physical products of about $10 million a week. I think one of the things that happens is that the distribution channels for gold are much broader. And so you don't necessarily see the statistics show up in the places that you used to see them show up. What we have found is that interest in gold in all levels of our business, institutional, retail, governmental, is much stronger than it was 2 or 3 years ago. Certainly at one point in time, the principal way that people participated for a while was the physical ETF. As Frank says, increasingly that's a vehicle for volatility as opposed to a vehicle for gold ownership. But as an example, at Sprott, we're actively engaged in outreach to conventional financial services, financial advisors. We've been trying for 6 or 7 years to interest them in the market. After 6 or 7 years, we're suddenly overnight successes. We're being, adopted by the sort of Raymond Jameses and the Merrill Lynches and the Credit Suisses. So I would argue with the thesis. I think that we're an extremely, extremely healthy market. People would like a more dramatic upside, but in my experience, when you get these, hockey stick charts, the backside is just as steep as the front side, just substantially less fun. And we have a market that's sort of climbing a wall of worry. It advances and then it backfills and advances again. I think this market is extremely healthy. Not too hot, not too cold, just right.
I would say, these guys are in the gold business. They have a much better look at this than I do, but I think a lot of it is cultural. I think when people in the West decide it's time to buy gold, they don't think about buying gold coins. They think about buying gold stocks, they think about buying ETFs, whatever it may be, whereas in Asia, where most of Perthman's sales will go, people buy gold coins first. So I think that's an important thing to understand.
I want to talk gold mining stocks now. I get a lot of viewer mail where people say, again, gold price is doing great, but we're not seeing this translated as much as we like yet on the mining front. And now, is it just slow to react as we've seen in the past, or what's going on here, Frank?
I think it's going to change. What's happened is that so many of the mining companies were great destroyers of capital. They just destroyed capital. They did dumb acquisitions, which were non-accretive on a revenue per share, non-accretive on a cash flow per share, and non-accretive on reserves per share. And then they just turn around and blew money in some of their other projects. I think there's much better discipline in the capital markets, and I think there's going to see Pac-Man that they're going to be buying the mid-cap stocks. They're going to take them out because the big caps need to have the increase in production or even maintain the production. So I think you're going to see more institutions start coming into the gold stocks. And interesting enough, Apple now is 3 times greater than all the gold stocks in the world. And that's just a remarkable trade. And you can buy things still that in the gold sector. I think the global gross margins are pushing 20%, and the returns on invested capital are over 15%. So if they do that for 3 years, all of a sudden institutional money will start to buy into it.
Rick, agreeing with you.
Frank's exactly right. The disconnect between gold and gold stocks has to do with the historic underperformance of the gold miners. In the last decade, the gold price went from, $250 to $1,900, and free cash flow per shares in the XAU went down. That took special skill.
Well, a lot of those companies were hedging, though, early on in that rally. So
that doesn't accommodate it. You had really, really, really skilled underperformance. And a wonderful thing's happened. It happened slowly, but markets worked. About 70% of those management teams were allowed to pursue other employment opportunities at the end of the decade. And what Frank says is there's this sudden sense that gold mining companies ought to make money. A really sort of charming idea. And Frank's exactly right with this, if the industry can prove to investors that they're not going to destroy capital, I think they'll do extremely well. I think you also need to draw a distinction. By the way, the senior gold miners, on average, depending on the discount rate you use, are trading at 1.7 or 1.8 times NPV. So the idea that they're very, very, very undervalued is probably fallacious. If you have a business that's in, one would say, occasional decline, and you're trading at 1.7 times net present value, that's not the same as undervalued. The juniors, give me 1 second, Peter. The juniors are a very different circumstance. That sector's way, way overcapitalized. There's probably 2,000 juniors worldwide, of which probably 500 are viable. So, the business itself consumes way, way, way too much G&A and basically only sells hope. That doesn't mean that there aren't great juniors. It just means that the idea that some of the issuers have that the junior resource industry is undercapitalized is fallacious.
Yeah, I just wanted to make a comment that the idea that gold stocks need to make a profit, maybe that's a novel idea. Imagine if that was applied to the rest of the stock market. I think last year we set a record for the percentage of IPOs that were losing money, and I think we have more publicly traded companies today in the NASDAQ that are losing money than ever before. So they're all acting like gold stocks.
Well,
Yeah, we taught them.
well,
But it didn't work for the gold stocks because these stocks are going up.
Well, I had someone tweet to me, why invest in juniors directly when all the money is flowing into ETFs, sucking up capital growth available?
I think that's a really good question, and that's a very important question. If I'm right about what's happening, and we are seeing investors shift into the gold space, everybody in this room that has taken the time to actually do some research and come and meet companies, meet management teams, understand real businesses, has a fantastic opportunity here, because you can park your money in the ETFs while you do your due diligence, and then you have a chance to put on some real trades and try and pick and choose the winners versus the losers. But if this move comes in, just being in the ETFs, that's where the public are going to go. They're not going to come out here and do this. They're going to read, or their broker's going to tell them that gold stocks are the new hot thing, and they're going to buy the ETF. It really is that simple. The people that put their boots on the ground and come and understand the companies will have a chance for some tremendous outperformance. But in the meantime, if you believe this is happening, just parking your capital in the gold stocks that you want to commit to the space in the ETF is going to be a really smart play, I think.
And I know we've brought this up multiple times, but when you're each doing your homework and picking the miners you like, let's just go over some of that criteria that's so key for you.
When you go down the food chain, it's management. That's just so key of betting on the jockey. The jockey's going to find the asset. The jockey's executed it before. They have a big equity interest in the company. They're usually very frugal, and they want a big stock position, not just stock options. And I think that's where you have to focus. And as you go up the food chain, you have to see where there's greater disciplines of generating returns on invested capital. And that's what Rick was saying, that a lot of these guys lost their jobs and they got kicked out because they had no discipline and made serious blunders of economic decisions, which were negative returns.
But do you also feel that one of the problems this industry is facing of not being able to let it go, that some mining CEOs or geologists just can't let a project go even though it's not moving forward? Don't we have to practice and learn from just maybe moving on from certain projects?
Yeah, I think so. I think there's more discipline, that people won't give them capital. It's very hard right now to raise capital for junior mining. So you have to have a track record. You have to have a proven track record. Otherwise, you're just not going to get money. Would you agree with that?
No, I disagree completely. Of course, I'm a check writer, so I think the industry's overcapitalized.
So are you usually giving money out to a bunch of these mining companies? Just
the ones that we feel deserve it.
Right.
For the companies
Right.
that we think are attractive, there's a bun fight to give them money.
But
I mean, the lame, the halt, and the blind.
just look at the number of financings. The total dollars raised last year for gold stocks, junior exploration companies, and flow through is at a record low with gold up that much.
Listen, Frank, for sure the issuers are looking for the return of dumb money.
And that's not happening, is what I'm saying.
Right. No, I
That's
agree
not
completely
happening.
with that. But I would say that companies that deserve to get financed are getting financed. There's
Correct.
a lot of money around for a rational proposition. It's just that there's a shortage of rational propositions. The industry doesn't want a return of smart money. The industry wants a return of dumb money. You and I are going to do fine in this circumstance.
Yeah, but I just take a look at the number of brokers selling deals and the number of deals, and I've tracked the funds going to flow through where there's a big tax advantage, and it's unbelievable how little it is. So that means that that dollar for exploration is only going to go to those companies which have something unique or special about them, and it's usually management, or like that's the reason why I went into AI, because that will help companies explore.
Well, that's probably the way it should be. I mean, maybe one thing that happened is that, Vancouver's youngest, most aggressive, best and brightest went from an industry they didn't actually like or understand, like mining, to industries that they liked and did due diligence on constantly, pot. The best entrepreneurs in Vancouver went to a business that they were experienced in and enjoyed. And, maybe that's contributed to the slowdown in financings.
I want to get to some other questions. Like I said, I had asked people on Twitter to send you guys all their burning questions. And then someone asked, if everyone's so bullish on gold, why do we only talk about a 5 to 10% allocation of the metal in one's portfolio? Should it not be higher?
Yeah. Well, Ray Dalio, the largest hedge fund in the world, is between 6 and 15% and recalibrates when to capture that volatility. So I think that's sort of a good math to take a look at it. But you have to think of rebalancing when you get these big moves in bullion. It's just prudent because things do rotate plus or minus 20% over any rolling 12-month period.
Peter Schiff.
Yeah, well, I usually say 5 to 10% as a minimum, and then you can have more depending on where you are in a cycle. Because I look at gold as liquidity, as a store of value, as an alternative to lower quality stores of value like the dollar or the euro or the yen. So if you want to have dry powder, keep it in gold. And if stocks looks expensive and if real estate looks expensive, then hold more gold, waiting for the prices to come down. And then when they get cheap, then you would use your gold to buy more stocks or buy more real estate. But I'm also advocating now that people have a pretty good allocation to the mining stocks in addition to just that 5 or 10% in physical gold. Because again, I think they're very cheap right now. I think there will be a big rally at some point, and then you can lighten up on those stocks. But for now, I think that people should have a bigger allocation because I think the risk reward is very skewed right now, and all the alternatives are just so expensive. You can't buy bonds. Stocks are ridiculously overpriced. So what are you going to do?
Frank Juster actually tweeting also, wanting to know from the panelists, is there any way out of this monetary mess the world is in, or has that ship sailed?
There is no way out.
Yeah, no, I think,
All right.
that's the shortest answer you'll get to any question.
Okay, moving along. There you go, Frank Juster. All right. Some people on this panel have a lot of disdain for Bitcoin. I'm looking at you, Peter Schiff.
Well, I lost all mine.
I'm going to get to that in a second. Hold on. But why can't gold and Bitcoin just coexist and everyone's just happy and there's harmony? Why can't there be room for both?
There is room for both. There's a simple answer. I mean, it's you've got two very passionate, let's be diplomatic, passionate communities that strongly believe in their chosen preferred asset, and it is both are a belief system of sorts. And whenever you get a belief system, people tend to go all in with these things. And I think what's been fascinating to me has been to watch some of the very best and brightest Wall Street minds that I've met in 35 years in this business really embrace blockchain technology. I don't want to call it Bitcoin, but really embrace the possibilities that affords. But the one thing they all have in common is there's certainly, I can't think of any, but I won't say there aren't any, but they haven't left gold and gone to Bitcoin. I think Billy Connolly once famously said that the definition of intelligence is being able to hear the William Tell Overture and not think of the Lone Ranger, which I think is absolutely right. And being able to hold these two contrasting opinions in your mind at the same time, that gold and Bitcoin are both worthy stores of value in their own way, is a difficult thing for a lot of people to do, but it's an important thing to do.
Well,
they can coexist because they're coexisting right now in China. 65% of all transactions in China are not with a credit card and they're not with cash. They're with like a WeChat, and that mechanism is basically, one of my analysts was in China and he had to go get a toothbrush and they wouldn't accept a credit card of any form. They wouldn't accept cash. It was only if you had his iPhone for the wallet. And at the same time, they're huge buyers of gold. And they're going to buy lots of gold rats this year because it's the year of the rat. And if they have any family members that were born in the year of the rat, they're going to give them gold rats because it's prosperous. So I think that they can both coexist. And I think that many of the younger kids in North America and Europe, they've been playing these mobile games. And Machine Zone has shown $6 billion dollars in revenue, and there's more money spent on mobile games by young men and boys than the total combined of movies and music in 1 year. So they all get rewarded by digital money in those games. And they don't get rewarded with Bitcoin, but they're all psychologically conditioned, behavioral psychology 101, to accept those digital currency to upgrade into that new game. And so they're the ones that are very quick to accept digital money. So I think it's just going to evolve.
How on earth did Peter Schiff lose his Bitcoin? Was the number one concerning question I got.
Well, before I even mention that, just the idea about whether or not they can coexist, of course they can. If anyone is foolish enough to buy Bitcoin instead of gold, they could do that. I just don't think Bitcoin is going to work. I don't think it's going to survive over time. I mean, initially Bitcoin was marketed as a medium of exchange, and that clearly didn't really work. So then they reinvented it as digital gold, but that's not going to work either. But people could buy it if they want, but just eventually a lot of the young people who are buying it are going to end up losing a lot of money, and that's a big problem. But the way I lost mine, and I didn't buy any. I collected them, over time. People would give them to me and stuff. But I had a wallet, and the last time I tried to use it, it just no longer recognized my password. Something corrupted it, I'm not really sure. I didn't forget my password, I 100% know what it is, it just doesn't work. And so I can't open it, and neither can the company that owns the wallet. They told me, well, if you forgot your password, just keep trying it, different variations.
And you had
I didn't
your
forget
caps
it.
lock off.
I know what it is. But anyway, so now they're all gone. But fortunately, it wasn't a large percentage of my net worth. At least I still have my gold.
All right, wrapping up the panel. I had so many other questions, but let's, stepping outside of gold, let's talk about the PGMs, platinum, palladium, rhodium, just on fire. Does anyone on the panel feel strongly about these metals right now? And how are you investing in them?
Yeah, mea culpa. I was a little early on that trade, 6 years. So it's fun to see what's happening. The disparity, first of all, between platinum and palladium, I think has to do with two things. One, that platinum is more efficacious in current technologies for diesel engines, and the Volkswagen scandal, of course, hurt demand for diesel and hurt platinum relative to palladium. Ironically, palladium used to be cheaper, so more fabrication technologies evolved for palladium use. The consequence of that is that now people are working very, very, very hard to figure out ways to substitute platinum for palladium because it's cheaper. Finally, on the demand side, that's above my pay grade. You really have to pay attention to advancing technologies. And at age 67, that's not a core competence of mine. But on the supply side, you need to note that with regards to PGM metals, they come from Russia, a fairly opaque country, to South Africa, Iraq, to Zimbabwe, which is a joke. 80% of the world's supplies of PGM metals come from places where the supply chain could be threatened at any point in time. Despite the upcycle in platinum and palladium, about 50% of South Africa's mines are uneconomic at current prices, and there's enormous pressures in South Africa to raise the social take from mining and to increase workers' wages. There's also hundreds of millions of dollars of sustaining capital investments that have been deferred because there isn't the money to do it. So assuming that the economy stays intact, and I'm not saying it will, I'm not saying it won't, that's the preserve of Peter and people who are economists. Assuming that the economy stays intact, we have real supply issues in the platinum and palladium business, having to do particularly with South African production. Russian production's in good shape.
Yeah, and it's really a supply restriction with an ongoing quiet demand growing each year, but the supply is contracting. And recent electricity issues in South Africa curtailed production. That's why you see South Africans reaching into North America, making investments here. North American palladium got bought out because they have to look for assets outside. So we're long the palladium, and we're long several of the platinum and palladium stocks. And Ivanhoe Mines is probably the best spec of them.
It's just, rhodium's just, inching closer and closer to 9,000, and too small a market, I know, but it's the most expensive precious metal right now. Gentlemen, any final thoughts for our wonderful audience and investors watching?
I have one. I remember saying in 2001 to this audience at the beginning of the last market, Being in Vancouver, you're just in an absolutely perfect place. You live in a community that's about mining. You can talk to the executives firsthand. If they won't return your call, they're telling you they don't care about you, so don't buy their stocks. There's just no excuse for anybody in this audience not making an amazing amount of money in the next 5 years. I remember many years ago in Midland, Texas, after the oil bust, a bumper sticker saying, "God, give me one more boom. I promise not to waste this one." Don't waste this one. It's coming to you. You're in the right place at the right time. Have a really good time. Make a whole bunch of money. Remember to sell 5 years from now or whenever the time comes that you think you're smart. But you could not be in a better place at a better time than you are right now.
Wow.
So if you're not wrong, you're wrong.
Wow, okay. Well, on that note, I had a lot of fun for a Monday morning. Thank you so much. Thank you to all of you for coming out, and happy birthday, Grant.
That's right. That's right. That's right.
Thank you.